Hello, welcome back guys. In this video we're going to chat about Micron technology, and it is a company that we have made quite a few videos about in the past. I have also made one recently actually, but there is a thing, the things have changed, and Micron came out yesterday, the CEO basically, and talked a little bit about what we are expecting from the smartphone market, which seems to be slacking a little bit. It seems like we're gonna be getting some declining growth, and it's looking probably we're looking into negative territory for the upcoming quarters. Now let's see what actually happened there, and before that you can kind of already see that pre-market we are down 5% right now for Micron, and so this may be slowly getting us to a better opportunity, which we will examine a little bit later. But first, let's take a look at what is happening with Micron. Earnings reveal dismal outlook for semiconductor market. Now, you will see here that for the most part, Micron has beaten its recent earnings. However, they are projecting lower guidance and frankly disappointing guidance, it looks like, what is happening here. Now, you will see here the numbers. They have called for Micron to deliver adjusted earnings per share of 2.43 on a revenue of 8.64 billion. And they surprised actually to the upside with adjusted earnings per share of 2.59. That's a pretty nice beat, and revenue of 8.64, as you will see. And the problem here is, for the most part, the worrying outlook, as you'll see over here. Despite the positive news, of course, we are expecting that the next few quarters are going to be lower. And this is why we're looking at the dip at the stock price right now. Now, as you'll see here, we're anticipating some numbers. For example, the revenue of 7.2 billion. And even if this is the top estimate for this projection here, it still falls far below the 9.005 billion that were expected initially. So it looks like we're gonna be having some downwards trajectory here for for the market. It looks like the semiconductors market may be facing that as a whole because of China, Ukraine, and Russia, and for the most part, I'd say by far. More than important is the inflation that has been caused, and the lockdowns is what really affected the whole market here. And another interesting thing here in terms of Micron, they warned weakening consumer demand with what I mentioned earlier will hurt smartphone sales here, again because of what I mentioned, China, Russia, Ukraine, and inflation, of course. And as you can understand, we are looking at a potentially 5 to 10% decline, it looks like, based on what the CEO is saying here. And that translates to quite a few millions in terms of units. As you'll see, it amounts to like 130 million units reduction versus expectation, which is interesting to notice. Now, near the end of the quarter, we saw a significant reduction in industry bit demand, primarily attributable to end demand weakness in consumer markets, including PC and smartphone, is what the CEO said over here. These consumer markets have been impacted by the weakness in consumer spending in China, the Russia-Ukraine war, and of course rising inflation. And as you would expect, shares have fallen on this news, and we're gonna expect potentially for them to fall a little bit more. Today it looks like it's gonna be even more against pre-market, is what we're looking at in terms of the pre-market at least. We'll see how that ends up when the market actually opens. But Micron has been down significantly, and we're looking at probably a 50% decline overall. And it's worthwhile taking a little bit of a closer look, because it looks like we're going to be heading towards $52, something of that sort. It's looking very possible, even less potentially. It is a stock that I would be definitely interested in adding to my portfolio, so I will be monitoring. And first things first, you can see here that the PE ratio is 7 here, is much low. The price to free cash flow is a little bit more elevated, but still low. Of course, for a company of that sort, it could be even better, of course. But 6.95, 25, we kind of need to see what the difference is all about here. Why this sort of profitability doesn't lead to the similar results in terms of free cash flow. We'll examine that. But outstanding shares that are about the same, a little bit lower. You always like to see lower. So as long as they're not issuing shares, that's good. The total liabilities to free cash flow ratio 6 means that it would take about 6 years of last year's free cash flow to pay back all their total liabilities. meaning that the company is more than likely kind of solvent here. Again, we will examine the finer details because it makes a ton of sense to examine the financial statements. And you will see here that the free cash flow growth has been going down. It's the only metric really that has been going down, with revenue and net income going up, but not tremendously, as you will see. Now, the price to sales is actually rather low here, indicating that we're getting tons of revenue compared to the actual money that we're paying for the stock, and very nice margins, as you will see from this company, and a great return on equity here is another nice thing. Now, a dividend yield of 0.5%, low yield, but very easily payable. As you'll see, the payout ratios are super here. Again, remember, net income is what the company generates more than free cash flow, and this is why the free cash flow ratio is a little bit higher here. Now, I always like, whenever there is a dividend, I always like to take a look at our dividend stub just to see how it has been growing through the years. This has been some very neat growth over here, and I'd say abrupt growth really, when you compare it to the previous years, but it's still rather low in comparison to, again, other stocks, and generally speaking, low than 1% is not that much, and it's easily payable from the company, by the company. Now, I want to take a look at the actual financial statements here because they can help me a little bit more with the numbers. 20 to 27 billion is what the company has been doing in revenue, and you will see here that the net income hasn't really been growing that much, from 5 billion to 5.8 billion. And in between, they have had better years and worse years. A lot of cyclical movement here, going up and down quite significantly. It's an industry that you would expect something of that sort to happen, but it's also an industry that it's probably going to get hot. Maybe not in the upcoming maybe 1 or 2 years, because of we could be entering a recession. We could be entering an environment where companies are not going to be spending too much. But once we exit that environment, we are looking potentially at some very interesting use of semiconductors. I was watching a very nice and interesting video from Kevin O'Leary, he was talking about data and how data is actually saved in data centers, which require lots of semiconductors and all that jazz. Super important and super interesting to think about. Again, if we enter a recession, this is going to be a little bit irrelevant, but for upcoming years, if you can get a good price on this kind of company, that could be a great addition to your portfolio, I feel. Now, the balance sheet of the company, you will see here that it has been actually growing at a very nice pace here, from 19 billion to 44 billion. And remember, the company has been buying back shares as well, so they haven't actually been issuing more shares to get total equity here. They have been buying back quite some. And you will see that the total assets have been increasing nicely, and the total liabilities haven't really been increasing. They're at about a similar level, if not less, actually. So looks like pretty interesting and good management from the company here. And I like to see that, of course, total liabilities of 15 billion here. And if we take a look at the cash flow statement, you will see that the company is making about 2.5 last year. And previous years they have made a lot more, although last year was pretty bad for the company, but previous years they have made a lot more. So this 6 to 7 figure in terms of the years needed to pay the total liabilities could actually significantly change the upcoming years for the better, I feel. So 2.5 to 15, yeah, it's about 7 or so right now. But if you take the average, as you'll see here, 3.5, it would be about 5. So it would be probably actually even less than 5, really. Close to 4. So it will be pretty nice and pretty solvent for the company. Now let's take a little bit of a look at what's going on here with the free cash flow and how net income translates to cash from operating activities, what's happening here. Now you will see that the company's net income has been increasing, although again not tremendously, and it has been going up and down a lot. But the net cash from operating activities from 5.8 in net income becomes to 12.47 in terms of operating cash flow here. A lot of depreciation, amortization, you can expect something of that sort for this company. It's an expense that is not a cash expense, it's deducted from net income, it's added back to the operating activities cash flow. A lot of capital expenditures. This is a very competitive industry. You do expect companies to pay a lot in capital expenditures, of course, to expand their operations and also to actually do their operations. It's an expensive business. It's a business that it has a very high level of entry, really. It's not easy to enter as a new business, and so that's a nice thing. for holding such a company. It's almost like an oligopoly. It's not like it's a small market really. It does have quite a few companies, of course, that are operating and making semiconductors, but it's not a massive market that has too many players like it could be, for example, groceries. Much easier to enter as a business. Now, you will see here that the company has been spending a little bit in investing, normal stuff. But the interesting thing is, of course, remember the capital expenditures that bring the cash flow down to about 2.4 billion over here. Now, the last thing that we need to examine is Micron is looking nice. A little bit all over the place, yes, okay, some years that are better, some years that are worse. The pandemic seems that they have really influenced the company, but it can also give us a nice price. Now, based on what the company is doing, is it a good idea, a good opportunity to enter right now? Let's take a look at our projections here. Now, the revenue that the company has been doing in the previous years has been tremendous, but they have also had these couple of years during the pandemic that they have been doing worse. So I will go a little bit more conservative than what the company has been achieving in, let's just say, the 5-year average. Of course, the 3-year average is deeply affected by the pandemic, but I will go, let's just say 10, 12 and 14 here. This may even be a little bit too much when we actually think about what's going to be happening in the next few years. Potentially, if we're entering a recession, we'll see. But this is a 5-year projection. Maybe the company can achieve that, especially if we have a couple of bad years and then we exit the potential recession. Maybe they can have even higher revenue growth if that happens. But 10, 12, and 14 may be normal if we enter a normal phase, really, for the economy. The net income margin here, we're gonna go for 20. Let's go 23 and 26, somewhere in between these values. And the free cash flow margin, we're going to go 30, 40, and 45, since the company has been doing 45 in the last 5 years, and 13% for our annual return. Let's see what we're getting out of this right now for Micron. Okay, as you could kind of expect, I was kind of expecting to be near the medium projections around $50, and our high ones are already met. It's only our low that is not met at all right now. It's very far, but our low has been 10% revenue growth, suppressing margins, deeply suppressing margins, suppressed margins here, and free cash flow margins that are also pretty suppressed. Actually, the company hasn't been achieving these margins none of these averages here over the last year. So I think that somewhere in between 40 and $50 is where my sweet spot would be for this company. I would love to be able to get in near 40, to tell you the truth, just to have a little bit of a margin of safety, because I think we're entering a phase where these kinds of companies can go lower potentially, especially if we enter a recession, can go much lower, really. And so while I love the company, I'd like to wait a little bit. It's a nice opportunity potentially if we are in a normal phase in an economy. I would more than likely buy this one if it reaches near 50 or so, but which seems to be happening actually in the next few days. But overall, right now, I think I may wait it out a little bit, see if it's gonna head a little bit lower potentially. Again, just because we're entering a phase where the economies are getting a little bit more suppressed right now. Hopefully this video helped you. Please remember to leave a like and subscribe if you enjoyed it, and tell me what you think about Micron. Leave a comment below. I'd love to hear your opinion. And thanks for watching again, guys. I'll see you soon. Have an awesome week and an awesome weekend, really, and an awesome summer. Summer is upcoming. I hope you're gonna be spending some time in the beach. Have a great time. I'll see you soon. Bye-bye.